Good morning, everybody. You're riding shotgun with Richard from Caliber Home Loans. What shall we talk about today? Let's chat about self-employment income to qualify for a home loan. So, who is self-employed? If you're not receiving a W-2 from your employer, you're self-employed. However, if you own 25% or more of the company that's paying you, whether you're receiving a W-2 or not, you're self-employed. So how do we calculate, or what income can we use on a self-employed borrower? A lot of people don't understand that, especially if you're a first-time home buyer who's never been down the road. You make great money being self-employed, but you write a lot of expenses off, which the IRS allows you to do that, and I totally get it. Nobody wants to pay more taxes than they have to. However, when you're applying for a mortgage loan, we have to use the net number, so after write-offs. So when you look at that self-employment, and we'll just talk a Schedule C self-employed borrower, so you're reporting all your income under a Schedule C. We're going to take the net number. However, we can actually add back in a couple things. For example, depreciation. We'll add depreciation back into that income. And I've seen that depreciation line be pretty hefty at times. So it may say that you made a net income of $20,000, but you wrote off $80,000 in depreciation of whatever it is, equipment you bought, things of that nature. We add that back into the income, so actually your income will be $100,000 that we can use. Now, other things that you got to be aware of is when you see that line item on the Schedule C that says meals and entertainment, we actually have to, that's a write-off, but we also have to deduct that again from the net income because the IRS only allows you to write off 50% of it. So we have to deduct the other half that you didn't write off because it's an expense. So they require us to deduct that meals and entertainment again. So just so you know. So that's Schedule C. There's lots of types of self-employment income, from corporations to partnerships, LLCs. Sometimes people own multiple businesses. We got to look at them all. You may have a positive cash flow on one business, but a large negative on another, and it could wash itself out. So, it's really important just to sit down with a loan consultant, loan officer, and go over it and figure out where you stand and where you need to be to meet your goals to purchase a home. Sometimes it might be, let's look at before you file or when you're getting close to the end of the year, kind of see where that profit and loss is. And maybe it's wise to make that large purchase of inventory or whatever it might be after the first of the year, so you don't have as large of a loss in the year you're trying to report to use as income to buy a home. So lots of things to look at with self-employment. A lot of people don't understand that, let's say you own a corporation, so you're W-2'd, but you own more than 25%. We actually cannot use your current salary on that pay stub. We have to go back and look at the history. So we're going to look at your W-2 wages and the tax returns for the corporation to figure out your income. So just to be aware of that. And once again, there's a lot to income when it comes to self-employment. I would suggest that we meet and figure out where you stand if you're self-employed. And then once again, there's other loan programs for self-employed borrowers that are non-traditional. But of course, you're not going to get the very best interest rate or loan going non-traditional type of mortgage, which is like a bank statement program where they analyze bank statements over 1 or 2 years and figure out your income rather than your tax return. That's a what we call a non-QM loan. I won't get into details on that, but so the best thing you can do is meet with a loan consultant, figure out where you stand, where you need to be to meet your goals of home ownership. Any questions, just reach out. Have a great day, guys.